one of the biggest things that we're doing is we're investing in hard, tangible assets. And this was a common theme amongst the speakers at this event. They love investing in tangible assets when a recession is on the horizon. It's a great time to invest because, you're down in the market, but you want to make sure that you're investing in the right assets. Welcome back, everyone, to another episode of Keeping It Real Estate. I'm your co-host, Mike Roeder. Now, today we're going to be talking about what we took away from the Limitless Financial Freedom Expo that we just got back from. It was down in Dallas, Texas at the Gaylord Hotel. There was about 1,700 investors, entrepreneurs, business owners, aspiring business owners that were at this event. So fantastic event. They had over 72 speaker sessions to choose from. So it was really tough to choose what sessions to go to. But we got to tune into a lot of good speakers. A few of the standouts were Robert Kiyosaki, Robert Kennedy Jr., George Gammon, Ken McElroy, Chris Martenson, an energy guy, all phenomenal speakers. So we're going to go into some of the details and some of the helpful content that we took away from this event. Now, before we get started, if you enjoyed today's episode, make sure to check out our other episodes on all platforms. Leave a rating and review if you can, and make sure to hit that follow button. So let's go ahead and dive in. First thing that I wanted to talk about was the economic indicators that these speakers were talking about and what they mean for investors. So during this event, a lot of talk about the economy, a lot of talk about the government, multifamily, other asset classes. So there was a lot of sessions on crypto, gold, technology, energy, social media, you name it. So we're going to go right into some of the current market trends. So one of the standout pieces of information in one of the first sessions that I was attending was the content about some of the big corporations across America and what they're seeing with sales. So they mentioned that Dollar General, Starbucks, Home Depot, McDonald's, they're all seeing their sales decline. And they've recently put out earnings reports, that show that they're missing their expectations. So this really points that we're likely heading further and further in the direction of a recession if we're not already in one. And we'll talk a little bit more about what that means and maybe, some of the things that you can do along the way to insulate yourself from the recession and to make sure that your investments are doing as well as possible. So looked up some stats, and Dollar General, so obviously a store where, a lot of individuals are going, especially when they're trying to cut costs, their sales growth stood at 0.5%, and it missed the anticipated sales growth of 2.1%. So you can see that that's dropping off significantly. Still a little bit of growth because of the sector that they're in, but it's dropping. Starbucks Q3 revenue fell 1% to $9.1 billion. Now, 1% might not seem like a lot, but that is a huge amount. So people are cutting back on that discretionary spending. Home Depot, obviously a must for a lot of people, but at the same time, it is discretionary for the most part. Customer transactions declined 1% to 386.8 million, and the average ticket fell 1.3% to $90.68. So people are cutting back there as well. And then McDonald's, obviously the fast food giant, they reported second quarter net income of $2.02 billion or $2.80 per share. And that's down from $2.31 billion or $3.15 per share compared to that year earlier. So some big declines with those big corporations that are usually very, very consistent. So again, that points us that or gives us the indicator that we're heading in a direction where a recession is on the horizon. If it's not already here, you're obviously seeing the Fed, coming out with statements that they're likely going to cut rates next month in September. Actually, September's here. So this month, which, should help move things along, but it's going to take time. There's a time lag in all of this. So a couple of takeaways there. Should help inflation. So these drops in sales volume should help with inflation. But the downside is, you're seeing some job loss. So you're seeing unemployment rates rise up a little bit each month. And when we were at this event, the vast majority of the speakers were saying that unemployment rates, will continue to go up because of the recession that's coming down the pipeline. So just be aware of that and make sure that you're, insulating yourself from that the best you can. Got the chance to listen to George Gammon, and he had a really interesting perspective on deflation. So it was a panel of 4 individuals: Ken McElroy, a big multifamily investor, was the moderator. And what George said is he said that he believes there will be a good amount of deflation or disinflation. So inflation just being at a lower level for the next 4 or 5 years. So basically for the next, from 2024 maybe to 2030. And then you're going to see a significant amount of inflation. And it might not take the next 6 years. It might only be, a year or 2 years. But he said, prepare for disinflation and deflation, followed by a good amount of inflation for a long period of time. So what that tells me is if you're in the multifamily space or any commercial real estate space, we're going to have a really good period over the next couple of years to not only acquire assets at a really nice discounted price, but to lock in some really good fixed debt financing with some low interest rates, and then hold that for an extended period of time while inflation rips. Because typically inflation is great for multifamily assets and most commercial assets. The thing that can really get you is if you don't have your debt fixed, then your interest rates are going to go up substantially. And that's the biggest piece of your expenses is your debt. So keep that in mind as you move forward. That debt, if you can lock in at a low interest rate, can be a huge, huge asset. We actually just closed on an apartment purchase, 256 units last week, and we were able to lock in a rate at 5.19%. So that's actually a really good interest rate when you look out at historical data. So keep that in mind, as you go forward. The speakers were also confident that interest rates are going to come down. There's about a 97% chance that the Fed is going to cut rates in September here this month. So they were confident that rates are going to come down, but that's not going to be for the long term. So they believe rates will come down. We'll get a nice dip. And then as inflation comes back, we will see interest rates continue to rise over the long term. So keep that in mind as you're investing and know that, interest rates, even though they're higher than they were a couple of years ago, they're in a really good spot, especially if you can lock with agency debt like we just did on that apartment purchase. Now, bank loans tend to be a little bit higher. So a couple other economic indicators. So another thing that George Gammon mentioned, which I thought was super interesting, is he uses the sham rule recession indicator. So this shows that we're currently at 0.53 and it's indicating a recession. So every time that indicator has been more than 0.5, there's 100% accuracy, he said, that a recession has followed. And right now it's 0.53. So he's very, very certain of that. Check out the sham rule when you get the chance. Obviously type it into Google or go into ChatGPT and it can lay out all the details. So what are we doing, as this recession looms, what are we doing, or what am I doing? What's Dan doing to really insulate ourselves from the recession? So one of the biggest things that we're doing is we're investing in hard, tangible assets. And this was a common theme amongst the speakers at this event. They love investing in tangible assets when a recession is on the horizon. It's a great time to invest because, you're down in the market, but you want to make sure that you're investing in the right assets. So commercial real estate, gold and silver. And they talked a lot about cryptocurrency. And I guess you could, argue that that's not a tangible asset, but that can be a great avenue as well. So investing in those hard, tangible assets that do really good when inflation comes back. Another thing that we're doing, like I just said, is we are locking in fixed rate debt. So that way we can take advantage of the current interest rates and mitigate our exposure going forward. So that way our biggest expense is fixed. So let's talk a little bit more about strategies for recession proofing your multifamily investments. And a couple of the sessions, they really honed in on this. So first off, Kenny McElroy owns about 10,000 units, very popular in the multifamily space. He's placed a lot of Robert Kiyosaki's funds over the years. And one thing that he's doing is he used to maintain, a few months of liquidity or cash reserves for each of his deals. He's upped that to 6 months of cash reserves for all of his deals. So that means that he's able to pay his debt and all of his expenses for at least 6 months with the liquidity that he has in the bank. So I think that's a great idea. As you put funds into commercial real estate, make sure that you have the right amount of liquidity. And then also another thing that we're doing is we're increasing the amount of CapEx that we think we're going to have to spend. And that's for two reasons. You just never know what's going to pop up as you own these assets. And then the second reason is, like I stated before, expenses are still rising and they may rise more than we think because of the inflation, that might come back over the future years. So make sure that you have a hefty CapEx budget and you have those funds sitting there for a rainy day. Prepare for higher interest rates in the future. Said it 2 or 3 times already, but lock in fixed rate debt if you can. Obviously, bridge debt can be a good strategy in certain circumstances, but that's not something we're looking to do because of the increased risk, in our opinion. And then also, George Gammon had mentioned, just be conservative, extra conservative when the 2-year and the 10-year treasuries are not inverted. And that's, coming up here relatively soon from their perspective. All right. So we also attended a session on investing for long-term stability and growth. Especially with what's on the horizon. So a couple of things to highlight. Multifamily and commercial real estate is a historically stable asset that meets the hurdle rate for real returns. And the hurdle rate, if you've never heard of that, it represents the minimum acceptable return on an investment, considering the risk involved, the cost of capital, the investor's required rate of return. So it's typically a great asset that hits that hurdle. A couple of other things to, consider or to compare multifamily to or commercial real estate to, I would compare it to all the investments out there. Bitcoin, farmland, industrial, retail. There's so many different asset classes. So take a look at what you're really looking to do with your funds and consider, the benefits and the pitfalls of each of those asset classes. So a couple of things that you should consider. You want to diversify over time. And actually, one of the speakers was speaking at the event, and he was asked, are you diversifying outside of multifamily? Because he's a big multifamily investor. And he said, actually, we're diversifying within multifamily. We're buying in different markets. We're buying different asset classes, maybe an A-class property and a B-class property. And so I thought that was an interesting perspective. A lot of people hear about diversification and they're thinking different companies, totally different asset classes, and that doesn't always have to be the case. You can just be diversifying in a different submarket or, with a different asset class. So keep that in mind, as you move forward. And then, commercial real estate, especially multifamily, everyone needs a place to live. So as we go into this recession, you might see unemployment, or you're likely going to see unemployment tick up. So you might see delinquency tick up a bit, but occupancy rates, should stay stable. And the other great thing is we're working through a lot of supply right now, supply that's coming on in all the major markets. So Dallas, Fort Worth, Florida, Nashville, you name it. There's a lot of supply coming on the line. And as we work through that, and as we get into 2026, 2027, the permitting has just dropped off a cliff because of interest rates. And so you're going to see a lot of that being absorbed. You're going to see rental rates continue to rise over the long term. And then you're going to see occupancy sitting at a very strong spot. So consider that as well. Another thing that a lot of the speakers talked about was the landlord laws that are in place and how different states really impact the success of your investments that you have in place. So they were just talking about how, they're investing in Texas, they're investing in Tennessee, they're investing in Florida, and how they're staying away from other states where the landlord laws are moving in the wrong direction, or, they're really terrible for landlords currently. So like New York, California, Illinois, there's a lot of states out there where they make it incredibly hard to get your residents out if they're not paying on time. We actually had an example of someone, I believe it was Illinois, and it took 14 months to get their tenant out, to get the eviction to be approved. The attorney or the lawyer, hammered down, yep, this is the result. And directly after that, he waved the resident up and told them how he could appeal that eviction. And so then, that was going to push the eviction out in, 2-3 months. They didn't give the finality of that story, but that just shows you it matters where you're investing. If you're investing somewhere where you can't get someone out for 14 months, there is no way you're going to be profitable, especially with those units, that are accumulating delinquency. And it's going to make it very, very tough to make your business plan successful. So take a look at the landlord laws, take a look at how business friendly the state is, and make sure to consider that when you're, factoring in whether you're going to invest in a deal or not. All right, so let's talk a little bit about building a resilient team and culture. That was a big theme of this event as well, and it was talked about in a lot of the sessions, which is so critical, especially in today's environment where it's so tough to find really good team members to join your team. So one of the main things was hiring and retention. Kenny spoke a lot about this, about hiring the right people and hiring based on attitude rather than experience. So if someone has a bunch of experience, great, but do they have the right attitude? So a lot of times, if you have the person with the right attitude, the right persistence, the right drive, they can be taught, the minute details and the industry and have a ton of success. Whereas if they have the wrong attitude and maybe they're a toxic person in the industry, not only are they likely going to be a bad team member, but they're going to rub off on average 4 or 5 other individuals that may quit, in your organization because they have that toxic attitude. So make sure to consider that. And then one of the other things that was talked about multiple times was hiring and firing based on core values. So if you don't have core values set up for your company, if you have a company, make sure to set those up as soon as possible. Communicate those with your team often and regular. And if someone doesn't hit one of your core values, they need to be let go very quickly, or that's at least our opinion. And then hiring people, if they don't match any one of your core values, that's a huge red flag, and that person should be, passed on, in our opinion. Culture and job satisfaction. So 80% of people leave jobs due to the culture. So who are they working with? What's the culture looking like? What's the vibe when they come into meetings? And, the takeaway from that is just build a great culture, focus on that. And if you're passive investing, or if you're, investing with another group, make sure that you're investing with a team that has a great culture for their employees. And you should be able to get that gut feel when you're interviewing these general partners on, whether they can create a great culture within their employees. And maybe you talk to, one of their team members within the organization about how their experience has been with the company. And you're going to be able to uncover that fairly quickly. Super, super important. We also talked about profit sharing and incentives. It's something that, a lot of these companies at this event do. And it's something that we've actually rolled out over the last year, where we're profit sharing with our team members. Now, the great thing about that is it creates, an even better culture. It creates great retention, but it also motivates them and drives them to do better for the organization, to push for success. And that obviously trickles down to the investors if it's an investment company like ours. So I think that's super important. And if you're investing with a group, ask that question. Do you profit share with your employees? And I think, if they do, that is just a fantastic way to really motivate individuals and to keep that retention high. And then also, are the right incentives being laid out for the on-site employees? So you want to incentivize your team members to really push for the right success indicators on these properties. So you want to make sure that you have the right leasing bonuses, the right NOI bonuses, the right maintenance tech bonuses for how quickly and efficiently they're taking care of maintenance issues. So there's a lot of things that you can do with the incentives to make sure that you're pushing forward to success. A couple other things before we recap and finish up for this podcast. We also talked. There's a lot of talk about energy. So Chris Martinson, if you haven't followed him or you're not following him, make sure to go check him out. A little bit more on the doomsday side, so just be aware of that. But in his opinion, there's definitely an energy crisis coming down the pipeline. So right now, to produce a barrel of oil, it takes about 1 barrel of oil in energy to pull all the oil out of the ground, get it refined, get it through the gas stations or wherever it's going. And that used to be a 20-to-1 ratio. So we used to be much more efficient on pulling out oil out of the ground because there was so much oil out there. So you're going to see that continue to decline. And the amount of energy that we're using is going to stay consistent or go up. And so basically looking out a decade or 2 decades, we're likely going to be coming closer to that energy crisis where we're not going to have enough energy for the GDP or the output that we're looking to do in this country. And that could potentially affect how quickly our economy is growing. So check out some of his information. Reach out to us directly too. If you want the slides and our notes from that session or any of these sessions, be happy to send those over to you. There is also a lot of talk about our freedom of speech and how that's really being stripped out through censorship and what's going on in social media, as well as all other platforms out there. So just be aware of that a lot of things are being censored right now. So what you're seeing, you might not be seeing the other side. Plus, some of the information could be misinformation as well. Robert Kennedy was speaking at the event. He spoke for about an hour and a half, some really interesting information. And he was saying that, his Instagram account got deleted because the White House was pressuring Facebook to do so. The typical airtime on these huge networks, CNN, Fox, and so on, is typically about 29, big interviews as you lead up to an election like this. And he's had 3. So he's been completely blocked out of those sectors. And so you just want to take that into consideration when you're following the news or looking on social media. There's a lot of things going on behind the scene, and anything that you can do to alleviate us being stripped of that constitutional right, would be greatly appreciated, because it is so, so important. So with that, let's go ahead and wrap up. A couple of things to pay attention to, as you move forward. Understand market indicators, and you can dive into that more, if you request the notes that we have. Maintain those cash reserves. Make sure you have plenty of liquidity, and that the general partners have plenty of liquidity if you're investing in any sort of syndication. Focus on core competencies. That's not what we talked about a lot, but it was asked, what asset classes would you invest in as we roll into this recession? And a few of the people mentioned, focus on what you're competent at, where your core competencies are. So for us, we're going to continue to focus on commercial real estate, specifically multifamily and triple net lease properties. And so if you have a ton of knowledge, based around one asset class, it may be a good idea to continue, focusing on that asset class. Build a strong team and a strong culture. Diversify in assets that are going to do well with inflation. That's super important, especially over the long term. And then, we encourage you to assess your own strategies and consider how you can apply these insights to strengthen your multifamily portfolios or just your investment portfolios overall. So thanks so much, everyone, for tuning in to another episode of Keeping Real Estate. Please remember to leave us a rating review. It helps us out a ton, helping us bring on guests, putting together content for this, and make sure to share it with someone if you enjoyed this episode. So have a fantastic week, and go out there and create some success.